long-term real estate goes up. In the short term, you could lose your shirt. Hey everyone, today we have the absolute pleasure of sitting down with Dan Simpson of Dan Simpson and Associates, Dominion Lending. Dan is a top mortgage agent here in Kitchener-Waterloo and Waterloo region, and actually one of the top mortgage agents in Canada. Dan's personally helped me with my own properties and also my clients with sticky situations or creative financing. So if you guys want to get the lowdown on mortgages, Dan's the man, so let's get started. Dan, it's great to see you.
Thank you for having me, Peter. It's an absolute pleasure.
This man has 15 years of experience?
15 plus, yeah.
Yeah, 15 plus, and he's crushing numbers here. He's got an amazing team, amazing support staff, and I've worked with Dan over the last, I don't know, six years or so. We've done many transactions together, and some sticky ones too that he's helped me out with. So, Dan, tell us a little bit about yourself. How did you get into the business? And you know.
Yeah, absolutely. So I've been in banking. Ever since graduating out of the university. 15 years as a mortgage specialist with a blue bank previously, and then made the transition over to Dominion Lending just under 2 years ago.
I like that.
Blue to blue, and good change. We've been growing like crazy. I took my team with me, and we've been expanding since. We've got 3 offices, Kitchener, Waterloo, and we're growing across all markets right now. So we've been bringing on some fabulous people. I've got a tremendous support team, lots of years of experience, and with a major focus on the client.
I love it. Listen, one thing I love about you and working with you is everything's always straight up. I can do it, or I can't, or if I can't, here's how we can. And the speed of things is, makes my life easier, and my clients love it too. So I really appreciate that. So what's going on with mortgage rates now in Canada? Where are they at right now? What's happening? Everyone's calling me. I'm sure they're calling you 10 times more.
Yeah. I mean, the interest rate environment's a little bit volatile, as we know. If we were looking today on a 5-year fixed CMHC mortgage, you'd be about 4.59, prime -1 on a variable rate mortgage. We've seen rates come down a little bit, and then with the recent inflation numbers coming out of the U.S., we saw the bond yields move up, and we saw fixed rates come up a little bit just in the last week or so. But overall, put it a little bit of perspective around. If you take a look at the last 30 years, we're kind of comparable to where we were back in 2007. But again, just sort of shedding a little bit of light. 2008, 2009, we had a U.S. credit crisis, followed by an oil crisis, then followed by the big word COVID, and we saw rates plunge and stay low really for the better part of 15 years. So we're kind of back to traditionally where rates typically were
hovering,
prior to, but still well below the 30-year average right now.
Yeah. So where do you see rates going this year, and what do you think is influencing that, right? Like, we'll get into what kind of mortgages there are, insured versus uninsured, but I think a lot of buyers and sellers are constantly connecting with me. What's happening? When are things gonna go down? Is it later this year? Are they gonna keep going up? Then there's a lot of misconception and confusion. A lot of the market from the real estate end is driven by not only rates, but also the emotional response to try to time the market at the bottom, or will it fall if I buy today, right? So tell me a bit more about that.
Yeah, so I think, if I look forward to this year and into 2024, in my mind, we've seen the Bank of Canada make some moves. We're going to see inflation eventually start to settle. Obviously they had to raise rates to deal with the inflation issue, and that's going to take a bit of time to work its way through the system. We're starting to see some signs now, which in turn has led to the bond yields coming down a little bit. So, if I look back the last couple of years, there was a heavy emphasis on variable rate mortgages, and that's actually shifted now. So we're starting to see fixed rates actually come down, a little easier to qualify qualified buyers on a 5-year fixed than what it would be on a variable, and we're starting to see customers sort of move away from variable rate options. So yeah,
Interesting.
So as we see inflation start to settle down throughout the year, I think we're probably going to see bond yields continue to come down, which again is going to improve borrowing power, and it's and it's going to be a little bit more. Fixed rates are going to be a little bit more appealing, and with that stress test, the 2% up and above the contract rate, it's likely going to make people a little bit more eligible for the price point that they're hopefully trying to buy within. So generally, I think this is going to be the year for the fixed rate. Fixed rate mortgages.
Interesting.
And then, and then eventually we'll hopefully see the Bank of Canada, once we start to see inflation teeter back down a little closer to that 2% target, we may see the Bank of Canada sort of step in and start to lower the prime lending rate at some point along the line.
So for, like, hypothetically, for a buyer looking to get in now, or maybe they already have equity, they own a home, they want to maybe level up into something. What I'm hearing you say right now is that you're recommending that they get into a fixed mortgage? Because I was thinking that it would make more sense to get into a variable now, pay a bit higher right now, but then once things ease off within, let's say, a year or 2 years, the rate will go down, and it probably would be less than whatever the fixed mortgage rate would be.
Yeah, quite honestly, Peter, like every borrower is going to be a little bit different. In the past, to go to a variable rate, that added risk was offset by potentially a lower interest rate. We've kind of gone the opposite now, where we're a point to a full point and a half actually above the fixed rates currently. So that risk for return, that taking that variable rate isn't necessarily there right now. But again, back to qualification, and in terms of being able to qualify buyers, at potentially higher price points, in a lot of cases we're having to revert to a fixed rate in order to make that happen, in order to keep those ratios in line to meet the government stress test requirements. That said, there's a variety of terms. So, there's 1 year to 5-year terms. Variable rate is good if you do potentially feel that, fixed rates are going to continue to drop. You still have the option of actually converting your variable to a fixed rate down the road.
Right.
So you don't necessarily need to wait for the Bank of Canada to drop the prime lending rate in order to get a lower rate.
Okay.
Somewhere along the line, if the bond yields continue to go, which I feel they will as inflation starts to come down, there could be an opportunity to convert that variable to a fixed rate at some point at a lower rate.
Okay, so Dan, let's say our viewers are brand new to this, they don't know where to start. What are the requirements to get a mortgage in Ontario, such as credit score, down payments, income, etc.? How can someone get started with this without anything?
Yeah, so first things first, Peter, what we would encourage is, we need to sit down, we need to talk about, again, things like their credit score. That can be a showstopper in a lot of cases if they haven't been able to maintain good credit history. So first things first, we want to talk a little bit about their behaviors around their credit, repaying their credit cards and their bills, etc. Talk a little bit about personal incomes. It's tough these days to qualify on a single income. So we often talk about, spouse income, child tax benefits, potentially co-borrowers, those types of arrangements. And then, of course, the biggie, down payment as well. So a down payment can come from a variety of sources. It can be gifted from family members. It can be savings. It can be RSPs for a first-time home buyer. They can pull up to $35,000 from their RSP in order to do that down payment. It's great. And then really, there's a couple of classifications in terms of how we sort of look at every potential buyer. It's, are they putting less than 20% down payment, or are they putting more than 20%? Right. So two very different qualifications. If they're putting less than 20%, they can do it with as little as 5% down. 5% on the first 500,000, 10% on anything up and above. But again, it's a bit of a tougher qualification. It's CMHC. They've got guidelines. And then, if we can't qualify with CMHC, then we look to the 20% in order to bypass the CMHC premium, but it gives us a few more flexible options.
Yeah. Now, would you say it's more difficult to get approved under CMHC, like an insured mortgage under 20% down versus 20% and up?
Yeah, for sure. I mean, there's 3 insurers in Canada, and they kind of operate on the same set of guidelines. And lenders are subject to the same qualifications when it comes to CMHC, Sagen, and Canadian Guarantee. Once we get past that 20%, then it becomes a little bit more subjective. There's still a standard stress test that would apply, but and that's where we've got access to a wide variety of lenders, because we also realize too is that not everybody's the same. Their financial circumstances aren't the same. Different down payments, different. Maybe they've had a little bit of tarnished credit history in the past. So that's where we rely on our lender partners, whether the bank partners or whether it be the credit union options. Some of our monoline lenders are really fabulous lenders that we like to work with, that also offer out B options if needed as well too. So there's a lot of ways that we can qualify potential buyers, and we look at the individuals, we look at their circumstances, and that's where we direct and figure out what's going to be the best option for them.
No, that's great. Now, Dan, in case people don't know, what are the benefits of working with a mortgage agent such as yourself versus one of the big banks?
Yeah, so I mean, first off, Peter, we do work very closely with the banks, I will say. But for me, the difference, and having been in the banking world for many, many years, is access. So limited choice. Essentially, when you work with a bank, you've got one product line. So again, not every client is going to fit the parameters of the lending criteria for one particular lender every single time. So having choice and having options. The great thing about being a mortgage agent and with Dominion Lending is that, our reach with our lenders, we work with so many lenders. Again, many of the banks, credit unions, monoline lenders, fabulous lenders like MCAP and First National, and then we've got access to the alt lending as well, and into private lending at the same time too. So we can help people regardless of their circumstance and situation, and we can not only get them in, but then we can also graduate them into even better options in the future. So we can continue to work with clients and give them better options all of the time.
So would you say that you have a bit of a better success rate? So pretty much, like a lot of folks will go to the bank, they get flat out rejected, or they get approved for a way less than possible, or they need something else, they need a bigger down payment, etc. So it sounds like you have a bit more flexibility in getting the deal done.
Yeah, absolutely. I mean, we're looking for solutions for clients, and if we get turned down on with one lender, there's so many other lender options that we can go to. So, we can always help a client find a solution, and then again, if we can also coach them in terms of what it's going to take in order to improve their situation to get them into another option down the road and maybe get them a better interest rate, we do that at the same time too. So the best part for me is that we're never having to say no. We're always looking for solutions, and we're always finding a way to get them the financing that they need.
Now, I've had many clients over the past years that they only go to a bank, this is what they're approved for, and they don't even get a second opinion from another bank, perhaps because they don't have a relationship with them. But I always tell everyone, get a second and third opinion. Understand that this is a very important transaction that you're getting into, and you don't know what you don't know. So one person might tell you one thing, and then you get a second opinion and they tell you something completely different, or they give you some good, valuable information, and then you can make the best decision that's right for you. So Dan, I've got a lot of buyers that will reach out to us. They're calling, they're in the process that they want to purchase a home in the next year or two. Their goal mentally is, I want to have 20% down. So obviously that jumps them into an uninsured mortgage, but they explained to us a little bit on how they could maybe get into a home sooner. They won't have as much of a down payment. They'll have to pay a bit of a insurance premium. Explain how that all works and how someone can get into a home sooner.
Yeah, I mean, realistically, when I look back at the buyers that I've helped get into homes and over the years, the majority of first-time home buyers typically do buy without having 20% down anyways. I think in part it's important to sort of educate them, where that down payment could potentially lie. They may feel that, it has to be in savings. It could be RSPs, it could be gifted funds from family, but, realistically, the majority of buyers typically do buy their first home with less than 20%. And the way I look at it is that house prices have dropped. If it's the right house, why not start building up equity a lot sooner? And instead of waiting to accumulate enough in order to reach that 20%, or maybe we engage and involve parents in order to get that gifted down payment in order to get them to that 20% point. That's always an option as well. But
they refinance, pull out some equity from their home, and then
help their children get there faster. Because again, the sooner they get into home ownership, the sooner they're building up equity, and they're not paying rent towards someone else's home. So
and a lot of folks are doing that, right? Like a common question I get, and sorry to cut you off, is how are all these people that are 25 or 30 buying a home? And the reality is many of them are getting, the parents are refinancing, they're pulling out a credit line, the kids are getting $50,000 or $100,000, which is helping them with whatever they have saved up, and then they're able to move into home ownership that way. So that's quite common. I'm sure you're seeing that a lot too.
Absolutely. And also what we're also seeing quite a bit of is we're seeing guarantors and co-signers. So realistically, a first-time home buyer, I mean, their earning potential is at its probably pretty close to its lowest, and they're going to continue to earn more over time. So a co-signer or a guarantor doesn't have to be the forever plan either. So part of that process is also coaching them, and also coaching the parents or the family members, whoever's willing to co-sign, that this could be a 2-year obligation. It's probably not going to be a lifelong obligation, but it's going to help them get into the home today, the home that they want to enjoy, and at the right time when the prices are actually a little bit lower. So.
No, that's great. Okay, Dan, so what are the differences between an insured versus uninsured mortgage, and who are the best candidates for either mortgage?
Yeah, so ideally with an insured mortgage, it typically would be your first-time home buyer. So someone that generally doesn't have the 20% down payment, or is also looking at purchasing a property under $1 million, and they intend to own or occupy the property.
Okay.
Yep. So that would exclude, again, anyone that's looking to buy for investment purposes as a rental property, or if they're looking to get into something over the $1 million mark, they would require the 20% down.
Okay. And benefits of uninsured mortgage, and who would be the best candidate for that?
Yeah, so uninsured, again, anyone that can put together the 20% down payment, or if they're looking to buy something for investment purposes, maybe they're not planning on owner occupying, or again, they're looking at a higher price point and maybe they're moving up from their starter home, and they're moving into something a little bit bigger, and they've amassed some equity in their current home, and they want to pull that out, or they want to sell their property and inject it into the next property. They're likely to put 20% down. Or, the other piece too is that 20% down, now we can get them into a larger variety of lenders, and also take a look at 30-year options in order to bring those payments down at the same time.
Make it more manageable.
Make it more manageable.
Yeah. Okay, now you touched on the insurance premium. Can you explain exactly how that works? How much is this premium for anyone who's going to be getting an insured mortgage with less than 20% down?
Yeah, so when you're putting less than 20% down, so again, you could purchase with as little as 5. The way the CMHC premiums work is it's based on the amount of the down payment. So as you put more down, the premium actually is reduced.
Yep.
Now the premium is added to the overall mortgage, so it's not necessarily something that's paid out of pocket. It's added to the mortgage and paid for over time.
Yep.
So there's actually we look at insurance in 3 ways actually. So there's the insured, less than 20% down. There's the insurable, so maybe they're putting 20% down, but maybe they still meet all the criteria of an insured mortgage. They've got good credit, they've got income, the ratios are all in line, the property's under $1 million. That's what we would call insurable, which is going to give you the best rates in the marketplace.
Yep.
And then we have also the uninsurable. So the uninsurable would be 20% down. Generally, properties over $1 million. Maybe we want to stretch that amortization instead of over 25. Maybe we want to stretch it out to 30 years. Very comparable rates, different qualifications.
Yeah. Now that just reminds me, we've got a lot of immigrant clients. They just got their permanent residency. PR card has ink freshly dried right now. They're ready to buy a home. They got some money from overseas, or parents sent something, and they're ready to go, but not every bank and lender is working with them. What are your solutions for that?
Yeah, so, and you look at the goals for immigration in Canada, it's huge, right?
Oh,
so,
yeah.
So this is going to be a big part of the growth, not only for housing, but also for our city, the region of Waterloo. So, and when they come over, the first thing they want to do is they want to buy a house.
Yep.
So, we again, permanent resident or temporary work permit, we can work with as well. Clients can buy with as little as 5% down. Now we do draw on, credit history, not only in Canada. Typically we like to see a little bit of established credit history in Canada if it's available, but we can also use, let's say for example, if we can get an international credit report from the UK or from the US, or maybe a letter of reference from their bank back home, we got programs with lenders that will allow us to use that in order to qualify them at the same time.
Love it. Believe me, guys, I get it. My parents are immigrants to this country, so I know the trials and tribulations of struggling to put things on the table, being rejected, people not taking you seriously because you're not from this country. So, Dan's got a great system for this. If you have any questions regarding, you're maybe 6 months away from getting your permanent residence, or you're planning in the future, reach out to us. We'll put you in touch, and we'll have a solution created for that. So Dan, let's say I'm a business owner, my company generates a lot of revenue, but I don't actually make that much on paper. What's the creative solution to be able to get approved for a mortgage with you?
Yeah, so realistically, when we look at it, 34% of the population in Ontario is self-employed. So that touches on a lot of people. And we do see a lot of self-employed people coming to us looking to get financing. And there's a lot of ways that we can do it. There's a lot of good bank programs where we can gross up stated income. The reality is, if you're incorporated, you're probably paying a small salary, maybe a dividend. You're hopefully retaining a good chunk of that business and that income and reinvesting it back into the business, and that's a good thing. They shouldn't be punished for that, and they can't get a mortgage as a result of that. So, we've got some, again, great bank programs, good credit union programs. We've got some programs for self-employed where we can take 6 months worth of business account statements. We can turn around, annualize that income, deduct off a little bit for expense, and then use that to qualify them with as little as 20% down payment.
Amazing.
So, and then we've got bank programs where we can do it with as little as 10% on a Sagen or CMHC style program as well. So, plenty of options, and then plenty of options on the B side as well too. Again, more than 1/3 of the population in Ontario is self-employed. You're not at a disadvantage by virtue of the fact that you've gone out and you've created a business and you're successful, but just not pulling enough personal income. We've got options. There's lots of lender options that we can use in order to get you qualified. We just need to talk and discuss a little bit about your business. And with a little bit of documentation, we can definitely get you approved.
Yeah, I totally get it. I've been there, right? When you're blowing all of your savings and pushing it into the business, and you want to get a home, you want to start things, you want to buy an investment property, you got to get through to some creative options, and there's a lot of programs and options out there. So as a real estate agent, we get vilified as an industry, right? There's a lot of misconception where a certain segment of the population thinks that we're setting the prices, we've created this mess, and the simple fact is that there's just simply not enough supply. There's more demand than supply. Prices go up like with anything. When you see agents in there bragging about that, it turns some people off, and I totally get that, especially if they're in a position where they're 37 and can't buy a home because the price of a condo is $700,000 or $600,000 or whatever, right? It's disheartening to see because, fortunately I'm able to do that, but I know a lot of people aren't, and they don't have the position where parents have a ton of equity, parents have been slaving away working, they don't have enough money to pay for their own bills and let alone lend money to their kid for a down payment. I know I have humble beginnings, so I know how hard that is. What are the steps that young renters can take, without owning a home, like first-time home buyers? what can they do to improve their potential to own a home in the future? What programs are there out there? What things do you recommend to kids of your clients or even the clients that you come across?
Yeah, it's been extremely difficult for a number of years now, Peter, for first-time homebuyers, and in as much as the government's made steps to try and improve the situation, back to your points, supply and demand has just made it increasingly difficult, and then with rising rates, it's gotten even more difficult and more challenging for first-time homebuyers. But I'd say the key here really is just to start early. I look at potential buyers, and the first thing they do is they go out and buy a vehicle, and they load up all their credit, and focus on the credit. That's the big piece. Try to keep debts to a minimum. Not only just making your payments on time, but also capacity is key. Just keep those balances under 65% of the limit. The vehicle can come after. Focus on home ownership. And understanding, what is it going to take in order to get there? What are the income requirements that I'm going to need in order to be able to afford a home of X value? Is it going to be a condo that I'm going to need to look at first? Am I going to need to step up eventually into something? And home buying can be we can engage parents. It can be a family situation where we sit down with the parents, the extended family, and we talk about what is it going to take in order to get you into a home, into your first home. And I alluded to in previously as well too, is that a lot of first-time home buyers, their earning potential has only continued to improve. So, we can look at, situation now when we bring mom and dad in, we help them get into the home. Again, it's not the end all. They're not going to be on that home indefinitely. It may be a 2-year stint where they have to be on title and as a co-signer, but eventually we're going to graduate them off and they're going to be able to do it on their own. So, realistically, at the end of the day, they got to be patient. Do all the right things, sit down and talk to a mortgage professional, understand what those steps are in order to get there, and just continue to work towards it. It's going to take time, and eventually there could be a little bit of deregulation by the government at some point that could also make it a little bit easier in order for first-time home buyers to make that step into home ownership.
Yeah, I think honestly a very important aspect is credit. And, this is my rant right now. We go to school, we learn about a lot of things, the Pythagorean theorem, but they don't teach us about how to manage our money, how to manage our credit. They don't teach us those responsibilities financially. So I think that this is something vital to all of the younger folks watching. You need to get your credit in order. If you have a credit card, it's not free money, you need to pay it back. And you need to not even use it to live. You need to use it to maybe get points or whatever and just pay it off all the time so that you build up that long credit history. Because, by the time, let's say you're 23, 25 watching this video right now, by the time you're 30, 35, your credit will be impeccable. You'll be earning higher. You might have a partner, and it'll come together for you. You don't necessarily need to buy a home at 25. It might make more sense to rent. You can be more flexible and nimble. And in many cases, depending on things, it costs a lot more right now with interest rates to purchase a home versus renting that particular home. It could be quite a significant difference, and that might not be the right thing for you. So by no means are we pushing that everybody needs to have a mortgage or everybody needs to buy a house, because they don't. But it's the Canadian dream. Everybody wants to get into home ownership eventually. It just depends on timing.
Yeah, and again, it's important to focus on your credit, but occasionally life happens, and poor credit shouldn't also be a death sentence at the same time too. So, again, we can work together to look at ways to reestablish the credit history. There are lenders, there's programs, even CMHC. So long as you've got a certain level of reestablished credit history, typically 2 years. 2 credit products is generally what most creditors will look for. And just continued improvement, and then it does become a possible option with as little as 5% down.
Which is amazing.
Which is incredible.
Because, for me, it's I had terrible credit too, ladies and gentlemen, because I was irresponsible. When you get out of college, they throw money at you, they throw credit cards at you. You go and buy new shoes or a new outfit for the bar or whatever, and you're just dumb. You're just not thinking. I never had anyone to coach me on money, so I had to figure it out and read books. Like, go on Amazon, you can find Canadian books on how to improve your credit. It's temporary too, right? If you messed up and you made some late payments, you can switch that around, right? And with hearing about products like this from CMHC, it gives people hope, because I feel like, and I've had clients too, right? They bury themselves in a bad situation. They go through a divorce, they lose their job, and they just get into such a rut that it's really depressing for them, and they can't get out of it, and they feel completely hopeless. So you need to start somewhere. Start with the basics. If you guys need help, check it out on Amazon. There's lots of books. Reach out to us. We're happy to give you our insight, and hopefully you get out of it, right? It takes time, doesn't happen overnight. It can take years, but as long as you have to start with one step, right? You can't just jump and climb Mount Everest in 1 minute. So.
Yeah, so in terms of purchasing your first house, buying a house with as little as 5% down is quite honestly, for a lot of people, it's the starting point of amassing some wealth. And often it can lead into other things. So you buy your first house, you build up some equity, you pull that equity out, you go and you buy a rental property or a second home, a vacation property, but getting that entry point into home ownership is the first step. Yep. And that's the key, right? And again, that's where, we work together, buyers, we help them, we guide them, we coach them, we help fix credit situations to get them into that house eventually. And we often engage family units, parents, and spouses in order to help make that happen and guide them through that process. And for me, it's an accomplishment at the end of the day, because, I've got clients that, again, we've talked about cycle, and you help them once, you help them twice, third home, fourth home, they've amassed a real estate portfolio, now you're helping their kids. Yeah. And, it all started off with that first sit-down session where you just got them in to the very first home for the very first time. And
they trust you, and
they do.
And it's a long game, right? Like, people get focused on the interest rates, and they get focused on the prices going up or down month over month, but you have to look at it from a 5, 10, 20-year lens, right? Because eventually that loan will get paid off, right? Eventually you're going to refinance and pull some cash out. Maybe if you want to risk it, you can get into investment properties or other avenues, right? But too many people think day to day, week to week, instead of thinking year to year and decade to decade. So
absolutely.
Yeah. Yep. Long-term real estate goes up. In the short term, you could lose your shirt, right? If you bought in February last year and you want to sell now, you're in a world of pain.
Yep. Well, if your intent is to flip a house, then absolutely, right? But, from my personal circumstance, I remember buying my very first house. I was a Canada Trust employee, 2000, the dot-com boom era, and I had some money and I wanted to invest it into my very first house. I laugh now. It's like my very first house, waterfront property north of Toronto, $92,500. Staff rate, 6.5% interest rate, and I thought, wow, what a steal, right? You don't want to be discouraged by 6.5%. Yeah. Look at what the value in that home is today, and I can tell you that that house is, not tripled, it's 10, 12 times its value.
Oh yeah.
Certainly don't be discouraged by the interest rate environment. Look at the opportunities, look at the property specific, and if that's something that interests you, let's talk.
Yeah. So. Yeah, and if you're buying it for 1 or 2 years, don't buy it, because who knows what's happening with the market, right? I always tell people, if it's a longer term thing, and again, you can't always look at it as just an investment. You have to look at it from the perspective of value and use, right? If you're buying an investment, probably that's a different story. But if you're buying something for yourself, you get to enjoy it. You get to have your first child in that home, raise that child, or maybe you're getting married, or maybe you're retiring, you're enjoying that too, right? So there's many different reasons to buy a home, not just, hey, it's a good investment. But long term, if you have 5 and 10 year windows, there's going to be ups and downs, there's going to be swings, there's going to be scares, and there's going to be unexpected scenarios. But long term, it's the right thing to do, I think, in my opinion. Dan, thank you so much for your time today.
Thank you for having me, Peter. It's been an absolute pleasure.
Hopefully you guys learned a bit, and Dan was able to provide some clarity on the mortgage situation here in Ontario and in Canada. If you have any questions, don't hesitate to reach out to us. we're here to help and provide some answers and solutions. There's lots of professionals out there, so always make sure you get a second and third opinion. And we'll see you guys on the next one. Peace out.